With an awesome dividend yield, substantial dividend growth, and market-dominating share price returns, SCHD, the Schwab US Dividend Equity ETF, is the holy grail of dividend ETFs and in my opinion serves as a fantastic foundation for any investor's portfolio. Especially if you're looking for a more hands-off, set-it-and-forget-it approach to investing, projections show that you do really well over a long period of time without having to lift a finger if you only invested in this one ETF, which is something we'll look at later in the video. But before we get to all that, in case you're new to the channel, my name is Ryan Williams, and here we strictly talk about dividend stocks and how you can invest in them to create passive income and reach financial freedom. So if that's up your alley, if you are on a mission to retire early, then hit that subscribe button. I'd love to stay in touch as we both continue to grow our portfolios. Anyway, moving on, usually I'm more partial to investing in individual stocks like Starbucks or Procter & Gamble, but earlier this year when I started my Roth IRA, I knew I wanted something a little more automated and something that would just continue to grow and pay me dividends in the background while I meander through life. And after comparing different dividend ETFs, I concluded that SCHD was where I wanted the great majority of the funds to be deployed in this retirement account, and that was for a few reasons, not the least of which was just because I really like this ETF's investment strategy. From SCHD's website, we can see that there are a couple things this ETF focuses on. First and foremost, it tracks an index focused on the quality and sustainability of dividends, which is exactly what we dividend investors are looking for, right? Quality and sustainability, two things that SCHD has dialed in. Next, this ETF invests in stocks selected for fundamental strength relative to their peers based on financial ratios. And really, guys, you can't have one without the other. You can't have a sustainable dividend if you don't have strong financials and strong fundamentals. So in other words, with SCHD, you're not getting sketchy stocks with no proven track record of success. You're buying into high quality, recognizable companies with strong financials and a history of consistently paying and growing their dividends, like Merck, Amgen, PepsiCo, which is a dividend king with 50 years of consecutive growth, Texas Instruments, Coca-Cola, another dividend king, Verizon. You guys get the point. As far as the companies within this ETF, you can rest easy knowing you're in good hands with your money parked in its 103 different holdings. Having said that, one thing I've heard people say is a disadvantage for SCHD is the number of holdings within this ETF. Some people think that 103 different stocks is not enough and therefore would prefer to invest in other ETFs like VYM, which has 446 different holdings, VOO or VOO, which tracks the S&P 500 and has 508 different holdings, or VTI, which is extremely diverse with over 4,000 holdings. Those are all pretty solid ETFs as well, and I do understand that reasoning, but I personally think 103 different stocks is still quite a lot, and I also don't think that more diversification always leads to better results. It's much more about investing in companies that you can count on, which is something I don't find to be in short supply with SCHD, and I think the fund's performance really speaks to that. And having said that, although SCHD is down over 15% year to date, which, let's be real guys, which stock is not down so far this year? If we zoom out over the last 5 years, we see that SCHD has yielded a pretty positive share price return, up 41% in the last 5 years. And over the last 10 years, it's yielded a 140.5% return, so very solid. Furthermore, if we compare SCHD's total return to that of the three major indices, the S&P, the NASDAQ, and the Dow Jones, we can see that SCHD is so far outperforming the broad market, or at least doesn't have as much of a drawdown this year compared to the three major indices. Additionally, if we zoom out across the last 5-year period, we can see the SCHD, for the most part, is outperforming the broad market. It's definitely beating the S&P by quite a fair amount, 22%. On the other hand, the NASDAQ has absolutely crushed SCHD as it has the other two indices, which is no surprise if you take a look at what the top 10 holdings are in the NASDAQ. But moving on, SCHD is absolutely dominating the Dow Jones index with twice the returns in the last 5 years. Now, if we compare SCHD to some of the comparable ETFs like VTI, VOO, VYM, which is basically Vanguard's version of this ETF, and DGRO, which is another high dividend ETF, we can see that year to date, SCHD is seeing less of a drawdown than all of these other ETFs, with the exception of VYM, which is beating SCHD by a couple percentage points. But if we zoom out over the last 5 years, we can see that SCHD is absolutely crushing, with a 64% return that is about 10% higher than its closest competitor, which would be VOO right here. So having compared its performance to the broad market as well as other comparable ETFs, it's going to be hard to find something that matches this ETF's returns, and we haven't even gotten to the good part yet, guys, the dividend. As you can see, SCHD is looking pretty nice in the dividend department. They have a starting yield of 3.58%, not too shabby, a very high 5-year growth rate, especially for an ETF, double digits, sitting over 12%, and a respectable dividend growth history as well, 9 consecutive years. And if we compare this to the same batch of ETFs we saw a moment ago, VTI, VOO, VYM, and DGRO, SCHD's dividend stats once again just top everything else. The The yield is higher than all of these other ETFs. The 5-year growth rate is also considerably higher than all of these other ETFs. And while VYM does have 11 years of consecutive growth, SCHD is not too far behind. And having said that, when comparing these two, it's important to remember that VYM has a little bit of a leg up on SCHD as it has been around for a longer period of time. SCHD is a little bit younger than VYM. So all across the board, both in terms of share price returns and dividends, guys, just nothing holds a candle to SCHD. And with that said, now I want to show you guys just how well you would do if you invested in this one ETF, only in this one ETF across a long period of time. To do this, guys, we're going to be using two different platforms, the Portfolio Visualizer first, and then the Market Beat Dividend Calculator right over here. But starting with this one, guys, we're going to go back 10 years. Let's say you invested $10,000 into SCHD back in 2012. And from then until today, you invested $100 every single month. From doing this, guys, with an initial balance of $10,000, after that 10-year period from 2012 until today, you would have ended up with $56,645, and your compound annual growth rate across those 10 years is 17.5%. That is huge. Now, that's just the share price returns. If we go down, this is the dividend income right here. Just in year one, you would have made $313. And if we go over to 2021, the last full years, that $300 or so would have turned into $1,800 every single year. So in the last 10 years, you would have 6x'd your dividend income. Now, to me, guys, that's an incredible return. And now, what would happen if you just kept that going? That was the last 10 years, but what if you kept that going for another 20 years from basically today until 2042? What would that look like? And that's where the Market Beat Dividend Calculator comes in. If we scroll down, we can see that across those 20 years, at the end of those 20 years, actually, your $300 of dividend income in year one would turn into $17,112.17, and your total portfolio value would have grown to $538,000. So in the span of 30 years, with an initial $10,000 investment, investing $100 every single month, which is not much, right, across 30 years, your $10,000 would grow into over $500,000, and you'd basically be bringing in almost 20 grand without having to lift a finger. So as you can see, across a long period of time, you do pretty stinking well investing in just this one ETF, which as far as I can tell is almost perfect. The only other potential drawback to SCHD, if I had to grasp for straws, is that there's no exposure to the real estate industry, which may or may not be something that's important to you. If it is though, if you are looking to add some real estate into the mix, then you need to check out this next video right over here where I tell you about 7 real estate investment trusts that have seen the biggest drop so far in 2022. These stocks are down 40, 50, 60% and are calling your name. So click right over here and I'll see you in the next one.